Well, hello everyone. Good evening. Today I'm going to take through stock options. These are very important part of your CPA curriculum as most of the time few MCQs comes out of it, sometimes a TPS. So let's get to the topic right away. Now see, this lesson, as an overview is presenting, this lesson will cover several concerning stock-based compensations. Stock options are just one type of them, and this lesson will have many others coming forward in subsequent lessons. Now, after completing this lesson, you must be able to account for stock option plans available to most or all employees of the firm, understand how the variables are used as inputs to the calculation of the fair value of an option, compute and record compensation expense, and prepare the entry for the exercise and expiration of options. Now, trust me on this, when you become CPA, you will realize that unlike Indian companies, lot of US companies offer stock option to their employees. So you are going to deal with this on an everyday basis. So better focus on it with me right now instead of learning from your boss, which will be like fired. So let's focus. Jokes aside, stock purchase plan open to all employees. Now, let me show you what that means. To be precise, there are two kinds of stock options. One is compensatory and one is non-compensatory. What is non-compensatory? Non-compensatory means firm is really not doing anything for you. You are getting stocks at more or less around the market value of the stock. So being an employee is not helping you at all. Non-compensatory also means that almost all the employees are getting it. So you are no Cinderella at the firm that you are going to have the golden shoes. No, everybody has the chance to participate in this. Then you can ask me a question. Why does the firm does this at all? To raise money. It is hell lot of a cheaper to raise money from the employees than to go in the market with an IPO. Second, it keeps employees invested in the business. As we all know, and if you don't know, I will tell you this right now, that human resources is the most valuable part of a company. Any company, be it in manufacturing, service, whatever. So a good way to tie your human resources to long term along with your own goals in your organization is to give them benefits. What are the benefits? If they do well, company does well. And if the company does well, the profit is high, stock prices go up, they are benefiting not only from their salary, but also from the stock price appreciation. So let's first of all understand that what is non-compensatory. See, first of all, you have to understand that what is the criteria for recognizing a compensation expense. See, non-compensatory is there only if all the five apply. If one of these five do not apply, the plan will be considered to be compensatory in nature. Yeah, you got me right. If all the following five conditions apply, the plan is non-compensatory. But if one of these do not apply, plan becomes a compensatory plan and accounting is different. So first condition is essentially all employees can participate. So everyone can participate. Does not matter whether you are a junior clerk, does not matter whether you are an in-house counsel, and does not matter whether you are an in-house accountant. I said in-house accountant because if you are a practicing accountant, independent public accountant, you won't be awarded this option since you are not employees of the company, you are their auditors. So first condition is what makes it non-compensatory? Because I am giving it to everyone almost at the same price. So there is no discrimination. Everyone gets a share of the cake and they can eat it too if they want to. Second, employees generally have to decide within 1 month of the firm setting the price for the stock whether to enroll in the plan. So there are first two conditions. See how they are closely interlinked. First condition tells all employees are free to participate. Second, it tells employees have to decide within 1 month that the firm gave them an offer or set the price for the stock. The technical term is setting the price for the stock, whether they want to enroll in the plan or not. Now, of course, you know that I'm an employee. If suppose I'm an employee at a Tata Consultancy Services or Apple for that matter, and if Apple offers to me the shares at the same price as the market value, why will I buy it from Apple? I can buy it from the share market. Why will I give my cash to my company? I can freely change hands. The cash can freely change hands in the market. So there has to be a discount. You have to give your employees some discount on the market price, but that discount cannot exceed the employer cost saving issued, inherent in issuing directly to employees. Now, what does that mean? See, whenever you go to the market, you have to understand that there is a risk. First, it might not get subscribed. Let's talk about Apple. Of course, it will get subscribed, but you have to pay underwriter's commission, issuing cost, printing, and other charges. To employees, you don't need to pay so many costs. Perhaps few paperwork is enough. You don't want to pay an underwriter fee or anything like that. So you can issue them at a discount, but that discount should not exceed the employer's cost saving that are generally inherent whenever you issue shares in the market. General rule is less than equals to 5% market price. It meets the criteria. And it's a very common thing that, see, market is very volatile. So today, when I'm setting a price, suppose Apple's shares is trading at $100 a share. I am setting the price at 96. 1 month later, the price can go up to 120, can go below 80. That will not change this. The price is set on an initial date and employees have to respond to this offer, see, within 1 month. So the price is already set. It can't be changed according to the stock market movements later on. So the price that is decided on the date, market price on that date is considered. And discount should not be more than 5% of market price. Up to 5% satisfied the criteria. It will still be considered a non-compensatory stock option because it is available to all the employees. Employees have a 1 month time period and discount is not more than 5%. So there is not a significant benefit in it for the employee. It's not that the share is trading at $100 a share for Apple and I'm getting it at $20. That's a huge benefit. This is just like any other issue. Now, purchase price has to be based solely on the market price of the stock. So when I'm talking about less than equals to 5% of market price, you are talking about solely the market price. You are not going to take into other considerations at all. You are not going to take what that employee brings into table, how important it is to retain that employee. No. Last, employees can always cancel their enrollment before their purchase date and obtain the full refund. Now, this is a very common thing. I saw Apple giving me shares at $95. The market price on that date, the date Apple made me this offer, I'm an employee. All the employees of Apple got this offer, was $100 a share. Now, 1 month later, there is almost 1 month, I immediately enrolled in. Happy man, wanted to make a lot of money, thought this was a cheap deal. 1 month later, markets crashed. Apple shares are worth around $90 now. Now, why would I buy it at $95 from the company? I can buy it at $90 from the share market itself. So employees generally are given this option that they can cancel any time before the purchase date, that is 1 month, even after enrolling, and they will get a full refund. Now, if all these 5 criteria are satisfied, that generally means yes, this is a non-compensatory stock option. If one of these are not met, all the employees are not given this option to participate. Employees do not have 1 month of the firm setting the price for the stock, whether to enroll in the plan or not. Discount is more than 5%, maybe 30, 40%. Purchase price is not based on the market price of the stock alone. And employees cannot cancel their enrollment. Once they're enrolled, they have to pay the money. Then this becomes a compensatory stock option. Now, this is mostly the criteria and you should remember them. But we are essentially accountants. We should know what is the accountant's part. Now, I have got an example. The example says the par value of common stock is $1. I think after teaching you entire equity chapter, you know what is a par value, right? Face value. And market price is $100. It's perfectly possible. Shares were issued way back. Market price today is 100. Employees of the firm can purchase their firm stock for $98. Now, first of all, you have to understand what is the discount, 2%. That is within the limits. And the other criteria are met. What are the other criteria? Essentially, all employees can participate. Employees have got 1 month. Discount, of course, we have seen is less than 5%. Purchase price is solely based on the market price of the stock, and employees can cancel their enrollment. So rest of the 4 criteria are met. Discount we can see. So the plan becomes non-compensatory. Now, situation number 1. So let me just note down few values for you. Par value is $1. Market price $100. Stock price offered to them, or issue price as we can call it, is $98. And they are telling discount criteria as we can see is met, right? Discount is 2%, which is of course less than 5%. So this criteria is definitely met. And they are saying all other criteria have been met in the question. So this is basically a simple non-compensatory plan. How do I account for this? Very simple. It is treated accounting. Treat it like a normal issue. What do I mean by it? Very simple. Suppose an employee purchased 100 shares under the plan. Suppose an employee has just purchased 100 shares under the plan. Now, what does that mean? Nothing much. It's very simple. First of all, normal journal entry, cash debit. I have 100 into issue price. That's 9800. Debit credit common stock. That will be 100 shares into par value. That's $100. Now, the question only remains is, what do I do with the APIC? Because there is an APIC, right? So I have to do something with the APIC. What do I do with the APIC? The answer is very simple. Market price will be ignored. APIC is the balancing figure. You can say it, balancing figure. Well, my hands at computer are not very well today. And it will go as $9,700. We completely ignored the market price, that is $100. We treated it like any other issue, and we considered that the issue price was 98. Cash was debited, common stock was credited, and APIC was credited. So this is the first portion. And I want you to feel comfortable about it. Nothing much. You need to remember these 5 conditions. Of course, first, all employees can participate. Second, they have to decide within 1 month of the firm setting the price for the stock, whether they want to enroll in the plan or not. Second, discount cannot exceed the employer's cost saving, generally less than 5%. Is the less than or equal to 5% is the accepted rule. Fourth, purchase price has to be based solely on the market price of the stock, and employees can cancel their enrollment before purchase date and obtain a full refund. So if that's the portion, it's very simple. Treat it like any other issue. You have nothing because the discount is considered insignificant in this case. And you can treat it like a common stock issue.